In the last 30 days, the ultimate financial safe haven just lost like 20% of its value.
Yeah, it's wild.
And this is while the world is literally sitting on the brink of conflict. So today, we are tearing down the illusion of the spot price.
It's a necessary conversation, honestly.
Right, because, I mean, picture the market right now for a second. It is late March 2026. Just 1 month ago, at the end of February, gold was sitting at this all-time record-breaking high of around $5,600 an ounce.
Oh, yeah, institutional desks, retail traders. I mean, everybody was just watching the charts in absolute awe.
Exactly. But today, today is trading at $4,600.
Right.
That is a massive $1,000 plunge in just a matter of weeks. And it's kind of defying almost every conventional macroeconomic model out there.
It really is. I mean, when you see a historically stable asset lose that much ground that quickly, it just sends shockwaves through the broader market.
For sure.
The velocity of the drop is what catches those institutional managers off guard. It basically forces this rapid reassessment of risk models and safe haven allocations across the board.
Okay, so let's unpack this. Our mission for this deep dive today is to figure out exactly why this traditional safe haven asset just lost $1,000 in value.
Right.
And, more importantly, to uncover the structural forces that are, secretly holding the physical market together behind the scenes.
Yeah, the stuff you don't see on the ticker.
Exactly.
Yeah.
If you only take one thing away from this deep dive, it's this. You are currently watching two completely different games being played on the exact same board.
That is a great way to frame it. And to map out those two games, we are leaning on a really comprehensive market analysis today. It's titled, Is Gold's Dip Your Smart Buy Signal? By Doug Young.
Yeah, Doug really knows his stuff.
He does. He brings over 20 years of experience in financial markets to this research. I mean, as a former financial director, he has evaluated over 80 gold IRA companies since 2011, I think.
Wow.
Yeah, so he really understands the plumbing of both the paper markets and the physical bullion supply chains.
Right, which is crucial for this. But real quick, before we get into the mechanics of his analysis, we need to explicitly note that this deep dive is strictly for educational purposes to help you understand market mechanics.
Yes, very important.
This is not financial, investment, or legal advice. Gold prices are, highly volatile, and past performance does not guarantee future results. So you should always consult a qualified financial advisor before making any investment decisions.
Right. Definitely conduct your own due diligence.
Always.
Yeah.
Okay, so with that established, the central mystery in Doug Young's research is just incredibly timely.
Oh, absolutely. We're currently seeing escalating geopolitical tensions right now, specifically in the Middle East.
Right.
And the traditional playbook dictates that when global conflict flares up, capital seeks the ultimate stateless asset, right?
Right.
And gold surges.
Which brings up my main question. If there's global conflict, shouldn't investors be sprinting for the gold lifeboat?
You would think so.
I mean, why is the price dropping? It feels like seeing a lifeboat sink while the
Yeah.
ship is on fire.
Yeah, it's a great analogy. The paradox here is actually the oil trade.
Okay, how so?
Well, usually, Middle East tension means a gold rush. But because oil spikes during these regional conflicts and global oil is primarily settled in U.S. dollars, we're seeing this massive sudden scramble for the greenback instead.
Oh, wow. So they need dollars to buy the expensive oil.
Exactly. Foreign nations suddenly need more dollars to pay for their energy imports, and that diverts liquidity completely away from precious metals. What's fascinating here is how that energy dynamic feeds directly into the U.S. dollar index, or the DXY.
Right, the DXY.
Yeah, it recently surged above 99, and because gold is priced in dollars on the global market, we see an immediate inverse reaction.
So the strong dollar basically acts like gravity on gold's price.
That's exactly it. It doesn't stop the underlying market from functioning, but it makes every single upward climb just exhaustingly expensive for foreign buyers who are using other fiat currencies.
I see. And that downward pressure from the dollar gets compounded by the current yield curve too, right? And the Federal Reserve's posture.
Oh, absolutely. The market is looking at recent sticky inflation data right now.
Yeah.
And they're pricing in the reality that the Fed is going to hold interest rates steady, or at least, keep them elevated for a lot longer than previously anticipated.
Which is a huge part of the macro picture.
Right. Because when U.S. interest rates remain elevated, the dollar yields better returns for global investors who are seeking safe, liquid yield. So capital flows into treasuries, which just bolsters the DXY even further.
Kind of like a feedback loop.
Yeah. Doug Young actually points out that this mirrors the aggressive dollar rally we saw back in 2022.
Oh, right, I remember that.
Yeah, during that period of U.S. economic resilience and aggressive Fed tightening, the dollar's strength weighed heavily on gold. It created a very similar headwind to what we're seeing today.
Okay, so the macroeconomic weight is clearly there. The strong dollar, fueled by the oil trade and sticky interest rates, provides that initial downward push.
Exactly.
But, I mean, macroeconomic shifts usually grind slowly. $1,000 drop in a few weeks, that requires looking at the actual plumbing of the trading floor itself, doesn't it?
It really does.
Like the strong dollar was the spark, but the trader behavior and market mechanics kind of poured gasoline on the fire.
Yeah, we have to shift our focus from those macroeconomic triggers to the micro-level market reactions.
Right.
The sheer speed of this retracement, it's a hallmark of futures markets and algorithmic trading models.
Okay, so the strong dollar nudged the price down, but the market mechanics caused a stampede.
Right.
It's like a crowded theater where someone yells, "Fire!" But in this case, the fire is a margin call.
That is the perfect way to describe it. Let's look at the leverage in the system. Before this sell-off, gold had been on this historic extended rally, breaking records to hit that $5,600 mark.
Yeah, it was everywhere in the news.
Exactly. And when an asset experiences that kind of momentum, speculative capital just floods the COMEX. But, and this is key, those speculators aren't taking physical delivery of gold bars.
Right, they're just trading paper contracts on margin.
Exactly. And the leverage ratios on those futures contracts are substantial. Doug Young's analysis details how the extended rally left the speculative side of the market severely overleveraged.
They were basically positioned for a permanent upward trajectory.
Yeah, they thought it would never end.
Mhm.
So when the strong dollar caused that initial modest price dip, it triggered a systemic technical unwinding.
Right, because the strong dollar nudged the price down just enough to breach the risk limits of those highly leveraged long positions.
Exactly. And once those risk parameters are breached, brokers automatically issue margin calls.
Right.
They require traders to deposit additional capital to cover their underwater positions. And if the capital isn't there, the trading algorithms automatically liquidate the paper gold contracts.
Wow. So that sudden flood of sell orders drives the spot price down even further.
Yes. Which in turn triggers the next tranches of margin calls for traders who had, slightly wider risk tolerances.
It creates this vicious cascading cycle.
Right. Sell orders trigger price drops, which trigger more margin calls, which trigger more algorithmic selling.
And none of this has anything to do with the fundamental physical demand for the metal itself.
Nothing at all. It is pure momentum unwinding.
That's crazy.
It really highlights a crucial lesson for anyone evaluating commodity markets. Futures trading and technical liquidations routinely amplify spot price volatility.
The paper market basically becomes completely divorced from the physical reality of supply and demand for actual gold bars.
Exactly. The traders moving thousands of paper contracts on a screen are dictating the short-term price action, and they're often forcing out weaker hands in the process.
Okay, so we have a scenario where paper speculators are fleeing the market, triggering automated liquidations, and driving the nominal price down $1,000.
Right.
But the price stopped at $4,600. I mean, it didn't collapse entirely.
No, it didn't.
Here's where it gets really interesting. While the algorithms and individual traders are panic selling paper contracts, the ultimate whales of the global financial system are quietly absorbing the physical supply.
Right. If we connect this to the bigger picture, the data reveals this massive structural support that is basically neutralizing the speculative sell-off.
Who are the whales here?
We are talking about the purchasing behavior of global central banks. Doug Young's research projects that central banks will purchase between 755 to 800 tons of physical gold in 2026 alone.
Wait, 800 tons. That is an unfathomable amount of capital to deploy into a single asset class in a 12-month window.
It's massive. To contextualize that figure, that single source of institutional demand absorbs over a quarter of the entire global annual mine supply.
Over a quarter?
Yeah. When central banks are systematically acquiring 25% of all the new gold pulled out of the earth every single year, it provides this massive concrete floor under the market.
Right, completely independent of whatever the COMEX paper price is doing on a random Tuesday afternoon.
Exactly. The analysis specifically points to institutions in Kazakhstan and Brazil, for example, accelerating their gold reserves.
Interesting.
It really highlights the dual-track world we're currently operating in. On one hand, the U.S. dollar's recent surge above 99 proves its depth liquidity is still absolutely necessary for immediate global trade.
Right, like buying oil, like we talked about earlier.
Exactly. But on the other hand, the long-term sovereign wealth strategy for these nations involves deliberate diversification away from dollar-denominated assets.
Because of counterparty risk, right?
Yes.
Yes.
The core driver for that long-term diversification is the mitigation of counterparty risk. The trend has been accelerating noticeably since 2022.
Right.
Sovereign nations are observing the geopolitical landscape, particularly the weaponization of the SWIFT system and the use of economic sanctions, and they are making a calculated decision.
They need a reserve asset that resides entirely outside the traditional banking system.
Exactly. If a central bank holds U.S. treasuries, they hold a promise from the U.S. government. But if they hold physical gold in their own sovereign vaults,
There is no counterparty.
right, nobody can freeze it, sanction it, or inflate it away.
Wow, so this sustained accumulation by sovereign nations acts as, like, the ultimate shock absorber for the gold market during these violent private sector liquidations.
Precisely. The speculative funds sell paper contracts to cover their margin calls, while the central banks use that resulting price dip as a strategic entry point to accumulate even more physical tonnage.
That is wild. But that structural floor isn't just a product of emerging markets diversifying, is it? I mean, the source brings the focus back to the domestic anchor right here in the U.S., too.
It does. It highlights the macroeconomic realities of inflation and sovereign debt. You really cannot separate gold's long-term trajectory from the fiscal mechanics of the U.S. government.
Right, because the analysis notes that the United States is currently running fiscal deficits exceeding $2 trillion annually.
Yeah, $2 trillion. The sheer scale of that borrowing requirement fundamentally alters the monetary landscape.
And it isn't just the principal amount of the deficit, right? It's the cost of servicing that debt.
Oh, absolutely.
With interest rates sitting where they are, the interest expense on the national debt is absorbing this massive percentage of tax revenues.
Which basically traps the monetary authorities in a corner. They are grappling with astronomical funding needs, which eventually creates immense pressure to monetize that debt.
Right, actively eroding the long-term purchasing power of the currency.
Exactly. And alongside that fiscal reality, persistent inflation is sitting above 3%. So this structural pressure, the combination of sustained deficit spending and sticky inflation positions gold as a vital non-yielding hedge.
It's the underlying mathematical reality of the fiat system.
Right. And that is what provides the firm floor under gold's multi-year uptrend, regardless of the periodic violent corrections we see in the spot price that are just driven by futures leverage.
Okay, so what does this all mean for the historical timeline? We've dissected the macroeconomic illusion of dollar strength, the micro-reality of margin call cascades, and the hidden structural truth of central bank physical hoarding.
Right.
Now, we need to step back and look at this $4,600 price point through a historical lens. Because, look, living through a 20% drawdown induces a lot of portfolio anxiety for people.
Oh, without a doubt. But Doug Young's historical data puts this current anxiety into very clear empirical perspective. The reality of financial markets is that straight lines do not exist, especially in secular bull markets. It's kind of like a heartbeat.
Right, straight lines don't exist in a healthy heartbeat.
Exactly. He points out that gold bull markets frequently and naturally feature corrections of 10 to 15%. It's an expected mechanism for clearing out excess leverage and resetting the baseline.
Basically, the market taking a breath and shaking out the weak hands after running a multi-year sprint.
Yeah, that's exactly what it is. The analysis highlights specific historical episodes to illustrate the mechanics of these drawdowns, too.
Like what?
Consider the 2008 global financial crisis. During the initial liquidity panic, gold took a severe dip. But it wasn't because the fundamental value of gold decreased.
Right. It was because institutional funds were facing massive margin calls in their equity portfolios and had to liquidate anything they could to raise cash.
Exactly. Gold was a highly liquid asset, so it got sold.
But once that initial scramble for cash subsided, the physical reality set in. I mean, that initial 2008 dip preceded a massive multi-year rally to new all-time highs as the market digested the reality of quantitative easing.
And we saw the exact same mechanical unwinding during the severe market volatility of March 2012.
Oh, right, the dash for cash.
Yeah, there was a violent short-term liquidation of gold as that dash for cash took over the global markets. But within months, that volatility resolved into substantial record-breaking gains for the metal.
Because the structural realities of monetary expansion reasserted themselves?
Exactly. Context really is everything here.
Yeah.
The source emphasizes that if we look at the data since 2022, the overarching trend is a massive, undeniable ascent.
Right, just a few short years ago, the baseline price for an ounce of gold was sitting around $1,800.
Right. So while a sudden retracement from $5,600 down to $4,600 feels drastic, and it triggers alarm bells across trading desks, you really have to measure it against the starting baseline.
The long-term trajectory is moving forcefully upward.
It is, and it's driven entirely by the central bank accumulation and the sovereign debt trends we just analyzed.
And the research also gives us a clear statistical time frame for these types of market corrections, doesn't it?
Yeah. Historical data demonstrates that recoveries post-sell-off in the gold market typically average between 4 to 6 months.
4 6 months, okay.
Yeah. These cycles beautifully illustrate gold's historical resilience in inflationary eras, even when the day-to-day algorithmic volatility tries to shake you out of your position.
It serves as a really necessary reminder. While each geopolitical episode or macroeconomic shock carries unique short-term risks, those underlying structural trends, like fiat debasement and sovereign physical accumulation, they tend to dominate and reassert themselves over a multi-month timeline.
Very well said.
All right, we have covered a massive amount of ground and market mechanics today. Let's do a streamlined recap so you know exactly which metrics to watch on your own dashboard moving forward.
Good idea.
Based on the analytical matrix in Doug Young's report, there are 4 key indicators you need to monitor to cut through the noise of the spot price. First is the DXY index, representing U.S. dollar strength.
Right. And right now, its surge above 99 is creating the primary downward gravity on the gold price.
Okay, second is central bank buys. With projections showing 800 tons of physical accumulation this year, this metric represents the highly supportive concrete floor under the market.
Exactly. And third is inflation and the CPI. With inflation persistently elevated by structural factors like energy shocks and deficit spending, that remains a deeply bullish fundamental indicator for gold in the long term.
Right. And finally, the fourth dial is Federal Reserve rate.
Yes. If the Fed maintains a higher for longer stance, the impact is a bit mixed.
Mixed how?
Well, it keeps the dollar strong, which makes gold sensitive to downside volatility in the near term. But it also massively increases the interest expense on the national debt, which is incredibly bullish for gold long term.
4 clear, data-driven dials to keep your eyes on as this market continues to evolve.
Absolutely.
Now, to further your own research, dive into the mechanics we discussed today and access a wealth of related, comprehensive analysis. You really need to head over to the Gold IRA Company's Bulletin website.
It's a fantastic resource.
It really is. You can find all of their research and data at goldiracompaniescompared.com. Let me spell that out clearly so you can bookmark it. That is goldiracompaniescompared.com.
Yeah, definitely check it out.
And of course, there is a direct link to this specific research and all the related information right in the episode notes for you to click.
You know, all of this raises an important question to leave you pondering as you watch the charts this week.
Oh, what's that?
We have spent this deep dive analyzing 2 entirely different forces operating in the exact same market. On one hand, you have the intense, automated, algorithmic sell-off of paper gold by speculators driven entirely by margin calls and leverage.
Right.
But on the other hand, you have the relentless, record-breaking accumulation of actual physical gold bullion by sovereign nations and central banks who are preparing for a new monetary paradigm.
Yeah, the whales.
Right. So what happens to the global financial system if the paper price of gold fully and permanently disconnects from the physical reality of who actually holds the metal?